What if the biggest tax loophole in America isn't hidden in some secret offshore account, but built directly into the system itself? Why do billionaires sometimes pay lower tax rates than teachers, firefighters, or small business owners? Is it corruption? Is it fraud? Or is it something far more uncomfortable, something completely legal? Today we're breaking down a three-step strategy that quietly shapes modern wealth. Buy, borrow, D. And no, this isn't some conspiracy theory. It's not a Cayman Islands trick. It's a feature of the tax code that has existed for decades. Let's start with a simple question. When do you pay taxes? You pay taxes when you earn income. Salary? Taxed. Bonus? Taxed. Business profit? Taxed. But what if you never create income in the first place? Step 1. Buy. Instead of earning and spending, wealthy individuals focus on acquiring appreciating assets, stocks, real estate, private equity, art. Assets that grow quietly in value without triggering taxes. Here's the key: you don't pay capital gains tax until you sell. So if your portfolio grows from $1 million to $5 million, but you never sell, you owe nothing. Now comes the genius part. Step 2. Borrow. If you're worth millions, banks are happy to lend you money, using your assets as collateral. And what does the tax code say about borrowed money? Loans are not income. Loans are not taxed. So instead of selling stock and paying capital gains tax, you borrow against it. You live on tax-free loan money while your investments keep growing. Imagine your portfolio earns 8% per year and your loan costs 4%. You're still ahead, and you haven't triggered a taxable event. This can continue for decades. But what about the debt? What happens at the end? Step 3. Die. When the asset holder passes away, something powerful happens. The stepped-up basis. Heirs inherit the assets at current market value, not at the original purchase price. All those decades of gains, for tax purposes, erased. If the original investment grew from $1 million to $8 million, the heirs inherit it as if it was bought at $8 million. They can sell immediately, pay off any loans, and often a little to no capital gains tax. The wealth survives. The tax bill doesn't. Now compare that to a regular worker. You earn income. You pay income tax. You invest what's left. You pay tax on gains. You pass assets to your children after decades of taxation at every step. Two people. Two completely different rule books. And here's the twist. This isn't illegal. It's not hidden. It's simply how the system was designed. Which raises a bigger question. If wealth is never sold and income is never realized, how do you tax it? That's why debates about raising tax rates often miss the point. You can raise capital gains tax to 50%, but if nothing is ever sold, it doesn't matter. Understanding buy, borrow, die doesn't just explain billionaire tax headlines. It changes how you see wealth, markets, and generational power. So next time you hear that the rich pay less, you'll know it's not magic, it's structure. If this opened your eyes to how the financial game is really played, subscribe to the channel because we're just getting started.